Hello and welcome to Big Deal. Now, equity market volatility has had an adverse impact on the deal street. So what is the investor mindset all across, and what's the big thematic shift in the investment strategy? Let's find out from our panel of experts who have their skin in the game. Let me welcome on the show Ashley Menezes of ChrysCapital and Anshu Kapoor of Edelweiss Wealth. Gentlemen, welcome to CNBC TV18. First, Anshu, since you are sitting here in the studio, let me begin with you on the macro environment that is really impacting the equity market currently. Tell us, how bad is it going to be? On which side of the argument are you on when it comes to the recessionary phase in the global market and how India is stacked at the moment, and therefore the investor sentiment?
Well, thank you, Nisha. Thank you for having me here. Before we talk about the bad and the worries and the fear and the scares, let's talk about the silver lining, the good part of it. I think the best part for us to consider is that there is no economic disaster.
Yes.
Unlike 2008, there was a bubble that burst, the housing market and all of that. There's no default. There's no corporate default. There's no sovereign default. So it is not an economic calamity that has come and hit us on our face.
Yes.
It is a very sharp U-turn on positioning of the Fed on interest rates.
Yes.
Right? So that is what is causing all this dislocation, volatility and all of that. So that's a good part of it.
Yes.
Consumer spending is resilient. Corporate sector balance sheets, bank balance sheets are best ever.
Yes.
Right? So those are all good factors for us to consider. What is not going so well is, obviously, we know inflation. It's all in the print every day.
Yes.
There's a very steep rise in interest rates.
Yes.
What used to happen over 3-4 years has happened over months.
Yes.
So therefore, this whole big plunge in risk assets,
yes,
that is a dislocation, that is a fear, and that is a worry.
Yes.
Equity markets have corrected. NASDAQ is corrected 30%, right? S&P is down 24-25%.
Yes.
All risk assets.
So how much more for Indian market? Because we have broken some crucial levels in this week.
Yeah. I think the onset of slowdown from a global perspective is beginning. And that is visible in the trade data.
Yes.
It's starting to show up in our data as well.
Right.
If you see our exports data, it's starting to show up there.
Yes.
Right? So it will percolate.
Yes.
Right? Somehow or the other, I think the financial conditions in this country, India, were quite okay, quite, stable.
Yes.
Right? And therefore, I don't think we corrected so much. But we are valued much above the global markets.
Yes.
And in absolute terms as well.
All right,
so
I'll stop you there, and I'll just make one important point that I've been saying, that yes, India may outperform the global markets, but it will be in the proportion to which the global markets fall. So the trajectory could be downwards. That is also one of the views in the market, and most people say that off the record. But Ashley, let me get you in to this discussion. Looking at the overall macro picture, now in the very recent time, just before the market started their falling trajectory, we saw some of the big, private equity funds make their fruitful exits, which is not a good sign because they could see what was coming in the equity markets. What is the overall investor sentiment at the moment in the PE/VC circles?
Sure, it's a great question, Nisha. First of all, I'd like to echo the very important point that Anshu made, which is there's nothing really that has befallen us from a calamity perspective, right? So the indicators are generally quite resilient. Yes, the biggest issue has been in terms of where valuations have been over the past few months, and we've seen that creeping up. There's always a justification as to why the valuations are what they are and what they should be. We are seeing a correction to that. That correction had been coming. I think had you asked analysts, even 2 years ago, people were expecting it. The timing of that correction was not certain for folks, right? Coming to how private equity views this, right? Private equity is a long-term product. Our funds are typically a 10-year product with investments ranging from 5 to 7 years. So when one looks at opportunities, one looks at markets, one needs to think of it as not what's going to happen over the next few months, but look at the 5-7 year picture. And from that perspective, India, with all of its indicators, is still a very, very attractive destination.
Yes.
One can argue about what the price should be for making an investment, but in terms of attracting capital, that will continue to happen.
Yes.
The fact that exits have occurred is also a pretty normal situation. Exits
Yes.
in a private equity universe, the intent is to get those exits out, as valuations expand. As your time frame sort of evolves and you reach the stage where you would like to cash out, and every firm would be prudent in taking chips off the table at different points in time. And so I wouldn't be unnerved by the fact that some investors have cashed out. The idea of private equity is that even if it's cashed out, a lot of that money always comes back in. And probably, seeing the track record and seeing, a good return, you actually attract more capital.
Right.
So I wouldn't be worried about the fact that some investors have taken exits out. There is enough skin in the game. There's enough capital invested, in private equity. Last year itself, private equity attracted as high as $70 billion.
Let me stop you there. There are two important takeaways. First, you said liquidity is there. Liquidity, in fact, was one of the big reasons for the digital revolution to take place and so much money being flushed into our startup unicorn space, right? So that is getting constrained because of interest rates. But to my bigger point, cash, taking chips off the table is not so much of a worry as much as private equity VC sitting with cash at the moment that they raised and not going out to invest. When do you think is the right time? And obviously, they expect the valuations to get cheaper from here.
Yeah, we are seeing the deal environment to continue to be robust. Now, is it at the same speed as as transactions were occurring, maybe a year ago? Probably not. People are taking a little bit more time, want to spend time doing more diligence, understanding the business better, understanding the resilience, the inbuilt within the opportunity. And so, it's more a deferment of that decision, if at all any, as opposed to the money not coming in. There is enough capital that has been raised on the private equity side, sitting on the sidelines, waiting to be invested, as you rightly said.
Yes.
So I don't see the dearth of money that's waiting to come in. Yes, will people be a lot more picky about the entities that they invest in? And will they be a lot more slower or sort of more, diligenced in that process? Yes, for sure. Will that cause some transactions to go away which shouldn't have, which is fine, which is perfectly fine. Those, you want to miss the ones that you feel are on the margin. And so from a private equity universe, I don't see much changing over the next 3 to 5 years.
All right. So actually, important points there. When is the private equity going to start buying when they think, obviously, the valuations are much cheaper? So Anshu, give us a clear picture of family offices, ultra HNIs that you deal with. How have they right now behaved in terms of their investment strategy? Have they taken money off the table from the equities, made their returns? And have they really shifted out in other categories? And we'll talk about the shift in themes later, but the overall investment sentiment at this point.
Sure. Nisha, first of all, the mood is not bad.
Okay.
There is this fundamental conviction on the India story. That is number one. And the second part, the big part, is that from an allocation perspective, it's a consistent allocation. And thirdly, I think these clients, the investors, have become mature in dealing with all these crises that keep coming.
Yes.
So there's a fair amount of calmness as far as the investor is concerned in terms of allocating to asset classes. On your question on how they're allocating.
Yes.
See, equity allocations have been very dynamic. Gone are the days where people said, okay, let me invest for 5 years.
Okay. From equity market perspective, how has the shift taken place? And is there a little muted interest in equity investments now?
See, as far as the direct investing in stocks goes, so as I said, there is a lot more dynamic investing happening. So clients came in into the IT sector. The IT sector was doing very well. Then they went into banking. From there, they went into auto, real estate, right, and now pharma. So there's fair amount of quick rotation happening as far as the equity allocation is concerned. As far as investing in AIFs, PMSs, and all of that is concerned, I think it's theme-based. if there are themes,
Okay.
there is allocation happening there.
Right.
Right? And a big chunk on mutual funds is now 30, 40, 50% is passive.
Yes.
Taking into consideration that it's very hard for managers to outperform over the long run. So the boring or the long-term investing is moving towards passive increasingly as far as the mutual fund investing is concerned.
So mutual fund has seen some outflows.
No, I think mutual funds keep seeing whatever the SIP inflow keeps coming, about $1.5 to $2 billion. Well, that's a good part of the India story.
Right.
That like clockwork, this $1.5 to $2 billion comes in every month in the mutual fund space.
Right.
And that is what has held up the markets.
Right. So good point there, and we'll try to understand more about the shift in the investment culture and strategy that has taken place with the changing environment in macros. Stay on with Big Deal. We are back in a jiffy.